Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello, Earthlings. This is Charlie Jewett with the Renovating Retirement Podcast, bringing you episode 75, entitled Home Equity Fails the Liquidity Test. Now, this week, or this section, these 5 or 7 podcasts, I don't know how many I'm going to do, but these are on mortgage planning, and this is where I cut my teeth in the industry. I was in the mortgage business. In 2004, 2005, and became a manager of 80 loan officers, and my job was Business Development Manager. Ooh, nice title on my business cards and everything. Well, really, my job was to crack the whip and make everybody do more loans. So I went out and studied all the top loan officers in the country, people making $1 million or more, and found something I wasn't looking for, which is that all the top loan officers were either also financial advisors or they saw the mortgage, the home mortgage, as an essential part of a financial plan that needed to be worked with in conjunction with the tax strategies and the investment strategies. Well, this changed the way I thought about mortgages forever. So I went to study under Douglas Andrews, who wrote the book Misfortune and Misfortune 101, which was Misfortune was like 600 pages when I read it. And my mind was absolutely blown at what was true about mortgages that nobody knows, and all of the things that are not true about mortgages that most people believe. So you've probably been taught that mortgages are bad, and the extent of mortgage planning that you should do is hate your mortgage and try to pay it off, and that's exactly opposite of what you're supposed to do. Well, how do you know that? Well, I wrote a book called The 2 Ways to Be Debt-Free. It's only 27 pages long. You can see it on Amazon, or you can go to my website, jewettwealth.com, Jewett, wealth.com, and you can see the entire, body of work here that proves that mortgages should not be paid off. But I'm going to do some podcasts on that right now and teach you why home equity is not a safe place to put your money, why you should not be sticking money inside of a house with large down payments, 15-year fixed mortgages instead of 30, extra principal payments, bi-weekly payments where you're paying every 2 weeks instead of once a month. All of those strategies are ways to get more equity, more of your hard-earned money sitting inside of your house where it fails all 4 tests of a wise investment. How do we tell if something's a good investment? If I say, hey, give me $1 million, I'm going to invest it for you. What kind of questions are you going to ask me? Well, the 4 criteria that people use to determine whether something's a wise investment are liquidity, can I access my money? Safety, can I lose my money? Rate of return, is my money growing and compounding, and at how much? Is it more than inflation? Those kind of things. And tax treatment. Do I have to pay taxes on the growth? Does it help me with my taxes? Do I pay less taxes because of this investment? So liquidity, safety, rate of return, and tax treatment are what we're going to go through in the next 4 podcasts. Today, we're going to talk about home equity fails the liquidity test. It's not very liquid. So I want you to imagine a home that's worth $500,000 and it's completely paid off. The person owns it free and clear, and they believe that was a wise investment. Okay? Let's take a look at it. As an investment, is the home equity very liquid? Now, when we say liquidity, we mean the ability to access your money when you need it the most. Is home equity liquid that way? The real question is, when is home equity liquid, and when is it not liquid? Let's say your house is halfway paid off. You owe $250,000 and your home is worth $500,000. You've done a great job building equity in your home. Let's look at a few of these potential whens that will help us to understand how accessible your home equity really is. Example number 1, what if you lose your job? Since 2008, I've known many people who've lost their jobs. When most people become unemployed, they have to tap into savings. Now, if you saved over the years, you ideally have an emergency fund that can cover your expenses for, 3, 6, or even 12 months. In the past, most people could find a new job within that time frame. What happens if unemployment lasts longer than your savings does, though? I have a friend who met with me years ago, and I taught him all the strategies I'm going to teach you in these podcasts. He said it wasn't for him. He just can't do it. In the 2008-2009 crash, he lost his job, and since then, he's gone through all of his retirement savings, spending down his 401k money to try to save his house, still doesn't have a job. Then he and his wife and their 4 kids were forced to leave their family home and they lost their home. Now, there's no guarantee that you're going to be able to actually get work in 3, 6, 9, or even 24 months. I've actually watched people lose homes, have to move out of California into states they don't want to live in because they didn't do what I'm teaching you in these podcasts. So what actually happens if you lose your job and don't find a new one before you spend down all of your savings? The result would be that you have to tap into other assets like retirement accounts, home equity, things like that. In our example, you've got $250,000 of home equity in this house. Remember, it's worth $500,000. You've paid it down halfway to $250,000. Awesome. That's going to help us get through this hard time. If you can get it, let's say you call the bank and say, I've been faithful all these years and I've made all my payments on time. You've been using that money I paid you to lend out to other customers and make an arbitrage, and you're earning interest on my money. I've hit some really hard times and I'm unemployed right now. So I'd like to borrow $50,000 to cover me until I find a job. How do I do that? Can I get an equity line of credit or just refinance my $250,000 mortgage to $300,000? Mr. Banker, tell me, how do I get the $50,000 to get me through this hard time? If you were in one of my seminars, I would say, raise your hand if you think the banker is going to say, I'm so sorry to hear that. Since you've been so faithful making your payments, let's get that loan taken care of for you. They're in the business of lending money, right? This is an opportunity for the bank to make more money, isn't it? No one in my seminars ever raised their hands at this point. But what do you think the banker's response will be? When your banker turns you down, you might ask them, why can't I have a mortgage? I've been so good to you guys. I've paid faithfully every single month and you have a ton of my money and I have all this equity. The answer you'll get back will be something like this. Well, you can't show us the ability to make the payments because when you don't have a job, you don't have an income. It's not about how faithful you were in the past when you could make the payments and had a job. It's about whether or not we think you can make the payments when you don't have a job and we don't think you can. But sir, you might reply, I'll be able to make the payments because I'll have $50,000 that you gave me that I took out of my home. I can make the payments. I've got a whole bunch of money. Even the banker knows your unemployment may last longer than you'd hope it would. He will tell you that he understands you could make the payments for a while, but there's no guarantee as to when you'll get another job. Many of the homes in foreclosure today and in the last 8-9 years are due to the owners losing their job and not being able to make the payments. It is wise to learn this lesson from the banks and make sure that all of our assets are accessible to us when we need them the most. Now, example number 2, losing your home. So home equity is not very liquid if you lose your job or your income or you're on disability. What if you lose your home? What if the home is compromised in some way? Now, in light of what happened in the recent years in New Orleans and along the New Jersey shore, imagine this situation. You live in New Orleans and Hurricane Katrina hits. Your house and your place of employment are both under several feet of water. You and all your neighbors hit the road heading to Florida. You try to find a hotel or maybe some friends to stay with for a while. Would your bank refinance your home when it's literally underwater? No way. But then you remember that you put a $50,000 home equity line of credit on your home just for emergency situations just like this. You call your bank to take a draw against your line of credit and are told by the bank that they've frozen all lines of credit. You cannot access any of your home equity. They took the line of credit away from you. This can happen. 48 hours after Hurricane Katrina hit, the banks began freezing all lines of credit, and homeowners were not allowed to access the home equity they so desperately needed at that time. I can remember calling all of my clients saying, take every last dime out of your line of credit right now before the bank freezes them. Some people did, some people didn't. Hurricane Katrina brings up another important reality about home equity. When something happens to your home, it's not just that you can't refinance to get cash out, or that you may not be able to use an existing line of credit, but getting the insurance company to pay the proceeds to rebuild that house might be harder than you would have hoped. When Katrina hit one particular area along the Mississippi coast, it completely destroyed 95% of the beachfront property. Imagine this is you looking at what used to be your backyard, now just a huge pile of debris. You say to yourself, okay, my house is totally gone and everything in it is totally gone. I'm sure the bank won't let me borrow against it now. I can't refinance. I guess I'll need to call my insurance company and rebuild this thing. I got to start from scratch and build a new home, and they'll give me the money. Thankfully, I have both flood insurance and hurricane insurance, so I should be good to go. All right, dial, dial, dial. You call your flood insurance company and ask them to rebuild the home as quick as you can. They're overwhelmed with claims as one of the largest natural disasters in the United States history has damaged many of their policyholders' homes. In short, they delay and tell you it was the wind that destroyed your home, not the water, so you need to go call your hurricane insurance company. Huh. How do they know it was the wind? That's weird. Anyway, you make the second call, and they give you the same exact line. They tell you that it was the water, the flood, the tidal wave that destroyed your home, and it's not their responsibility to pay. You need to call your flood insurance company. This back and forth tennis game of pain, this is the painful reality for the thousands of people who are still fighting with insurance companies today. I wish this were not true, but I've met face to face with several people in this very situation from the Jersey Shore, from Hurricane Katrina, and from the 2 firestorms in San Diego or in Southern California who are still to this day, 5, 7, 10 years later, fighting with insurance companies trying to get their homes rebuilt when they paid every single insurance premium on time. People, property and casualty insurance companies are completely different than annuity and life insurance companies. They're allowed to fight these claims. If you die and show the death certificate, you get paid your life insurance. If you have an annuity and are guaranteed a certain income, you tell them to turn it on, you get it every single time. Property and casualty, the claims can be fought. They've got more money than you. They've got better attorneys. You do not want to be in a fight with a property and casualty insurance company. In a New York Times article on September 2nd, 2007, Leslie Eaton and Joseph B. Treister said, insurance companies may have paid out $11 billion to Louisianans. That's a weird word. May have paid out $11 billion to people from Louisiana over the last 2 years since Hurricane Katrina. But they have also become the new villain in the tales people tell about the slow recovery here. Every neighborhood is full of horror stories about insurance companies that reneged on their promises, offered only pennies on the dollar in settlements, dribbled out the payments, lowballed the cost of repairs, dropped longtime customers, and sharply increased the price of coverage. That was the quote in the New York Times article. Now, I live in San Diego, California, where in 2003 there were a number of fires that swept through our county, destroying hundreds of homes. I know several families who lost their homes to the 2003 fires and still haven't been able to get the money from their insurance company. It's wrong. It's just a reality, people. I can assure you, property and casualty insurance companies have better lawyers than most of us can afford, and they have a lot more money to spend on them. So we do not want to be in a fight with these guys. Simply put, if you have to ask an insurance company for permission to have your own money, all the home equity that you stored inside of this tinderbox we call a house, then your money is not liquid. It's not accessible. The rule of thumb for home equity is that when you don't need it, you've got a great job, your house isn't compromised at all. When you don't need it, everything's going well, you can get it easily. Line of credit, refinance, whatever, sell the house. But when you need it the most, when you're unemployed, when you're disabled, or when something happens to your home or depreciation just crashes the value of the house, when you need it the most, you may not have access to it. Because of this limited accessibility during hard times, home equity fails the liquidity test. Now, I can teach you in future podcasts where you should be putting your home equity instead of accelerating your payments by making extra principal payments into your home or putting your tax return against your mortgage or having a 15-year fixed mortgage which pays more equity in faster versus a 30. I can show you where to put it instead of that. And in my book, I talk about how you don't want to own a home worth $500,000 and owe zero on it. You want to own a home worth $500,000, try to owe on a mortgage $400,000 or $500,000, but you want to have the $500,000 of home equity that other people put inside the home in an outside equity savings account. So yes, I want you to be debt free. I just want you to be debt free by having $500,000 of assets and a $500,000 mortgage that you could snap your fingers and pay off anytime you want to, but you choose not to because of the liquidity, the safety, the rate of return or arbitrage you're getting, which we'll talk about in 2 podcasts, and because of the tax treatment. Yes, you should be debt free, but you should not be trying to eliminate liabilities and store all of your cash inside of your house. Keep the liabilities. They're good for tax deductions. They're great for situations like I just talked about where you lose your job or lose your home. Build your equity in an outside equity savings account, which I can show you how to do. Do not pay off your mortgages. So the first test that home equity fails is the liquidity test. It is not liquid when you need the money the most, so it fails that test of a wise investment. All right, more on this in the next podcast, people. You can follow me on Facebook, Jewett Wealth Management or Renovating Retirement. Jewett is always spelled Jewett, or on Twitter, tweet, at Reno, Reno, _ retirement. I think you people are the best.
Renovating Retirement with Charlie Jewett.
That's all, folks.